My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I'm constantly telling you that discipline always trumps conviction. I say it over and over and over again. In other words, no matter how much you may love a stock, no matter how enthralled you are with the underlying company, if the rules say sell it, sell, you sell it. One thing I've learned in my investing career, no matter how much you might believe in something, you violate the rules of the road at your own peril. But where the heck do these rules come from? It's not like they were handed down from on high and carved into stone tablets. They're not like the laws of physics. You can't just deduce them from observing the way the market works, the way you can do, say, gravity. No, the rules come from experience, in particular my experience. I've spent nearly 40 years in this business. And in that time, you better believe I've learned some powerful lessons. In many cases, I learned them the hard way. And because I don't want you to repeat my mistakes, because I do want you to have the benefit of my whole career, tonight I want to lay out some of my most important rules for investing, the stuff I really live by. Now, some of this stuff may seem basic, but again, you forget the rules at your own peril. Back at my old hedge fund, where I labored for a long time, I'd occasionally convince myself that it was okay to make an exception, to have a cheat day, to ignore my discipline just this once for some reason that seemed compelling at the time. And whenever I broke my rules, well, let's just say I got burned. It's like that old joke about the guy who goes to the doctor and says, Doctor, it hurts when I stretch out and shake my hand around. To which the doctor replies, then don't do that. So what exactly should you be doing or not doing, as the case may be? Let's take down my most important rules for investing, starting with number one. Bulls make money, bears make money, and pigs, they get slaughtered. Look, I say this all the time because so often in my career, I've seen moments where stocks went up so much that people were intoxicated with their gains. Of course, they thought they were geniuses, too. However, it's precisely at this point of intoxication that you need to remind yourself not to act like a pig. I first heard this phrase on the desk of the old trading desk of the legendary Steinhardt partners. I'd be having a big run in some stock, and the legendary Michael Steinhardt would tell me that I'd made a lot of money, perhaps too much money. Maybe I was being a pig. I had no idea what he was talking about. I was just grateful that I caught a major gain. Of course, not that long after, we got a vicious sell-off, and I gave back everything I made and then some. That's when I enshrined the bulls make money, bears make money, pigs get slaughtered thesis as one of my rules. And now it's so deeply ingrained that I've got a barnyard full of sound effect buttons to tell the whole story, as I just did. The bull, the bear, the pig, and of course the guillotine. Just to be clear, bulls don't have a monopoly on piggishness. The exact same idea applies to investors who press their bets too aggressively on the short side. We've had some major declines over the years, but other than the dot-com burst in 2000 and then the financial crisis in 2008, 2009, systematic risk, most stocks did bounce back pretty quickly. And at this point, you've made a killing if you went long at the lows of 2009. But if you stayed short, if you were a pig who got greedy betting against the market when it was going down, you got slaughtered. Of course, it begs the question, how do you know when you're being a pig? Look, allegedly, there's no such thing as stupid questions, only stupid answers. But honestly, you don't need me to tell you when you're being a pig. If you didn't feel greedy when we hit an all-time high in the NASDAQ in 2000 after a 3,000-point run in almost no time flat, you don't need an investment advisor. You need a psychiatrist. If you took profits, you sidestepped a huge decline. If you let your winners ride, you lost a fortune. The financial crisis is even more stark. If you were walking around owning a huge amount of stock in 2008 as the banks started dropping like flies, you were beyond piggish. Why is this rule so important? It's simple. One of my chief goals is to help you stay in the game. The hardest part of investing is holding on through difficult periods, taking short-term pain so you can have long-term gains. The people who got wiped out by the dot-com collapse, they tend to be the ones who never took anything off the table. Where did they live?
House of pleasure.
They never felt greedy in their piggishness. Well, it got them slaughtered. Same goes for those who never came back from the financial crisis. Being cautious and ringing the register near tops ended up keeping you in the game. That's why I remind people every day, have you taken out your profit? Have you booked any gains at all? Or are you being a pig? Because you never know when stocks you own are going to really get crushed. You never know when the market could be just annihilated. You can't have certainty. If you assume stocks will keep going up forever in a straight line, I think you're going to be in for a world of hurt. Sure, there will be times when stocks just keep going and going and going. When I coined the term FANG a few years back for Facebook, Amazon, Netflix, and Google, which became Alphabet, I loved them all. But I gave up on Amazon after an amazing run. Now, it continued to move up and up and up, and I felt like a pig after the stock's extremely profitable move. But then I felt like a fool when it kept on galloping. That bugged me. But that is the price you have to pay for following these rules. You need to recognize that for every huge pile of cash that gets left on the table with a situation like Amazon, you're sidestepping gigantic losses like the kind you would have had if you had stuck with the market in 2000 and 2008. Experiences that turned two generations of investors against stocks, maybe forever. So never forget, bulls make money, bears make money, and pigs get slaughtered. And I'll keep on repeating it forever with the sound effects because it is just that important. Rule number 2, hey, it's okay to pay taxes. Look, no one has ever liked paying taxes. But like death, taxes are inevitable and unavoidable. Yet the aversion to paying taxes on stock market winnings often borders on the pathological. So many times people have gigantic gains, but they simply refuse to take any profits because they don't want to incur taxes that cut into their winnings. Wall Street is littered with broken hearts of investors who made this kind of mistake. A couple of years ago, for example, I went to a presentation from a prominent hedge fund manager who recommended buying the stock of Macy's because of the real estate value. The stock had already run a great deal, and it was ripe for some profit taking. But I know people who had owned it for years with hefty profits, and they didn't want to ring the register. Why? They would have had to write a check to Uncle Sam. Next thing you know, the stock of Macy's is obliterated, cut in more than half, and it wasn't a 2-for-1 split. The mall had hit a tipping point courtesy of competition from Amazon. And the darn thing just got crushed. Those who didn't want to share their profits with Uncle Sam ended up with no profit at all. What kind of lesson is that? So make your peace with the tax man. Some gains are simply unsustainable, need to be taken. A profit on paper is not the same thing as a profit in your bank account. Gains can be ephemeral. The last thing you need is to be worrying about capital gains taxes. When it's time to sell, you sell. In short, stop fearing the tax man. Start fearing the loss man. You won't regret it. And I'm not saying blow out everything. I'm saying take some profits. Bottom line, remember my top 2 rules. Bulls make money. Bears make money. But pigs, and don't be greedy. And a variation on that theme. It's okay to pay the taxes. Don't be so worried about taking a taxable profit because you may end up with no profit at all. Chris in Ohio. Chris.
Hi, Jim. Thanks so much for having me.
Sure, Chris. Good to have you.
So my question is, we have about $1,000 of disposable income,
Okay.
and neither of us have a 401k match with our jobs. So we're basically just trying to figure out, we have a mortgage. We're trying to figure out what would be the best thing to do with that extra $1,000 of disposable income.
Well, that's what an index fund is for. I mean, you can take 10% of that and use it for mad money. Buying a share of something, and that's okay, by the way. My first stock trades were 1 share, 5 shares, 7 shares. But you need an index fund to get started until you build up wealth, and then you can do it. How about Giacomo in Illinois? Giacomo.
Hi, Jim. Thank you so much for taking my call.
Of course.
Recently on the show, you talked about how first-time investors or younger investors should, stay away from riskier asset classes until they have $10,000 allocated in mutual funds or exchange-traded funds.
Yes.
Now, my question for you is, seeing, all this crazy bull market that we've got going on, seeing the market ramp up, seeing cryptocurrencies go up, if I don't have $10,000 invested in mutual funds, what should I be doing? Do I sit around and let opportunities pass and just wait it out and wait till I have my savings?
I totally understand. A young person, look, I want people to be able to save. That's my principal goal. If you want to put some money aside, some mad money aside, and do what I think is basically doing some gambling with it, I'm not going to stop you. But the thing that I most care about is getting people to save. If you're saving that way with some risk, as long as you understand the risk, I'm okay with it. But I cannot back away from index funds as the fundament of how you invest. Jeff in California. Jeff.
Hi, Jim. This is Jeff at Lake Tahoe. Thanks to you and your staff for your informative and helpful program.
Thank you.
I have a two-part question pertaining to interest rates and specifically yield curves. Can you explain to us home gamers what a flattening yield curve means? And more importantly, why do the analysts say when there's an inverted yield curve that it portends a recession coming? And the last part of my question is, what happens if the 10-year T-bill goes to over 3%? How will that affect the stock market in 2018? And grab your skis and come on out and see us here in Tahoe. Thanks, Jim.
You're very kind. I love Lake Tahoe. I used to play cards on the Nevada side. Okay, so an inverted yield curve, Fed has raised rates too high. Rest of the curve goes down out 5, 10, 20 years. That is a curve that has shown, in many cases, to lead to a recession, but in other cases not. So I'm not hard and fast in that rule. I do think that as rates go up, business does slow. That's undeniable. But we are at such a low rate, and business is so strong that we can afford it. Mike in California. Mike.
Good afternoon, Mr. Cramer.
Mike.
Listen, two things. One, first, thanks for taking my call. Number two is thanks for leading us 9 to 5ers down the right path to this little extra money.
That's all I want to do. Thank you.
Here's my question to you. I know you're in a hurry here.
No, I'm fine.
It's concerning dividends.
Yeah.
Just want to know, do you take the money and put it in your pocket, or do you put it back in the stocks? And if you do, how do you make that work, and how do you set that up?
Okay, you got to do dividend reinvest. Just have to do dividend reinvest. It's just a checkoff, basically, but you have to. My charitable trust, we're not allowed to. Got to give the dividends away. It has always hurt the performance. I always tell club members, please reinvest. Just take that money, because there's nothing like the compounding, the great compounding that you get, particularly with stocks that have good dividends. All right, remember my first two rules. Bulls make money, bears make money, and pigs get slaughtered. Please don't be greedy. Please be disciplined. And don't be afraid to pay the tax man on profits you earn. It's a lot better than riding things to losses. Takes them off the table. Much more mad money ahead. I'm putting my nearly 4 decades of experience to work tonight, counting down the most important rules for investing to help you navigate the market. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.